There's a major mystery brewing in the global markets, and right at the heart of it is the Indian rupee. It's been on this dramatic downward slide all year. So today, we're going to put on our detective hats and investigate what is really going on. Let's jump right in.
Okay, clue number one is this number right here, 89.46. Just recently, the rupee hit a brand new record low against the US dollar. It actually crossed the 89 mark for the very first time. What that means is the value of India's currency, when you stack it up against the dollar, has never been lower. And get this, it's not just a dollar story. The rupee has dropped about 4.3% this year, which gives it the less than stellar title of Asia's worst performing major currency. So while other currencies in the region are holding steady or even getting stronger, the rupee is really struggling.
Now, to really get a sense of how wild this is, look at this. Back in 1947, around the time of independence, one US dollar would get you about 4 rupees. Today, that same dollar gets you more than 89. It's a massive, massive shift that really highlights the pressure the currency is under right now.
So that's the big question, right? What is behind this? Is it about trade wars, panicked investors, or is there something else going on that we're not seeing? To figure that out, we need to track down the main culprits. All right, so economists have basically zeroed in on 3 big factors pushing the rupee down. You can think of them as the 3 main suspects in our little investigation here. Suspect number 1 is an outside job. It's an aggressive trade offensive coming straight from the United States. You know, at the beginning of the year, there was all this hope for a friendly trade deal, but that got thrown out the window pretty quickly thanks to some tough moves from Washington. And it all happened really fast. It started in July when President Trump announced some harsh new tariff plans and also warned India about buying Russian oil. Then in August, things really escalated. The U.S. slapped a huge 50% tariff on most Indian exports, plus another 25% penalty tariff. And as if that wasn't enough, by September, they were talking about raising H-1B visa fees to $100,000, which would be a huge blow to India's IT sector. Each move just hammered market confidence, and the rupee took the hit. All right, suspect number 2 is what happened next, a massive capital outflow. You see, foreign investors got spooked by all these trade tensions, and they started selling off their Indian assets and basically heading for the door. And when I say they pulled their money out, I mean a lot of money. By late November, foreign investors had yanked almost $16.3 billion out of Indian markets. All that selling creates a huge demand for US dollars. And when everyone's selling rupees to buy dollars, well, the value of the rupee is going to drop. It's simple supply and demand. Okay, on to suspect number 3. This one's a little different because it's a domestic player. India's central bank, the Reserve Bank of India, or the RBI. The RBI is walking a very, very fine line right now, and what it does and what it doesn't do is a huge part of the story. It's like they're playing this incredibly complex chess game. On one hand, they've sold over $30 billion since July to keep the rupee from going into a total freefall. But on the other hand, they stood by and let the rupee crash past a really important psychological level in November. Some folks think the RBI is actually okay with a weaker rupee. Why? Because it makes Indian exports cheaper, which helps companies fight back against those new US tariffs. It's a risky strategy. So, we've got our suspects lined up. But here's the thing. If we only look at the rupee versus the US dollar, we're not getting the full picture. Not even close. To see what's really going on, we need to dig a little deeper. And the key to unlocking this is a tool called the Real Effective Exchange Rate, or REER. I know, it sounds super technical, but stick with me. All you really need to know is this. Instead of just comparing the rupee to the dollar, it compares it to a whole basket of currencies from India's 40 biggest trading partners. It's a much, much better way to measure the rupee's true strength. And this is where the story gets really interesting. Take a look at this. Just a year ago, in November 2024, the RER index was way up at 108. That means the rupee was actually considered significantly overvalued, making Indian goods pretty expensive for the rest of the world. Fast forward to October of this year, and it has plunged to under 98. It has completely flipped. The rupee is now considered undervalued. That's a huge swing in just 12 months. So we know the rupee is falling, and we have a good idea why. But so what? What does this actually mean for everyday people, for businesses on the ground? Well, like with most things in economics, a fallen currency creates some clear winners and some clear losers. It really is a double-edged sword.
On the winning side, you've got exporters. All of a sudden, their products are cheaper on the global market, so they can sell more. Same goes for families getting money from relatives abroad. Every dollar they get turns into more rupees. But then there are the losers. Importers get hit hard. Everything from oil to iPhones gets more expensive. And guess who usually ends up paying for that? Yep, consumers through higher prices.
This quote from economist Arun Kumar just hits the nail on the head. He says the weaker rupee can help the economy grow a bit, which is good, but it also causes inflation to go up, which is bad. It's this constant, difficult trade-off. All right, just when you think you've got this case all wrapped up, there's a twist, a final piece of evidence that, honestly, kind of turns things on its head.
And that piece of evidence is this number, a positive 8.2%.
What is that? Well, that's India's latest quarterly GDP growth. While the currency has been tanking, the economy has been booming. It grew at its fastest pace in over a year and a half, totally blowing past all the expert predictions. It seems like the underlying economy is surprisingly strong.
So this leaves us with a real puzzle, doesn't it? We have a currency that looks like it's in trouble, but an economy that's firing on all cylinders. It's a contradiction. And that leads to our final question. Is this strong economic growth a real lifeline that could help the rupee bounce back? Or is it just a temporary bright spot in a much bigger storm? The verdict on that is still out.